Imagine waking up to find something you own has soared in value, then crashed before dinner. It's a rush of excitement, followed by a jolt of anxiety, all without ever leaving your living room. This isn't a theme park ride, but it can feel just as thrilling, and sometimes just as stomach-churning. Welcome to the world of tech stocks, where fortunes can change in the blink of an eye and headlines can send prices soaring or tumbling in seconds. This wild ride is called volatility, and in tech it's the main event. Prices can swing up and down dramatically, sometimes for reasons that seem mysterious or even random. Why? Because tech companies think Apple, Tesla, Nvidia, Meta aren't just selling products, they're selling visions of the future. Investors aren't just buying what these companies are today, but what they could become tomorrow. Their value is built on potential, on dreams of innovation and disruption. That means their stock prices are often more sensitive to news, rumors, and even tweets than traditional companies. Unlike steady companies selling soup or soap, tech stocks are bets on the future. They're about what could be, not just what is. Their prices swing wildly as investors react to every new twist in the story. Earnings reports, product launches, regulatory changes, or even a single viral post. This volatility isn't just for Wall Street pros, it affects anyone with a retirement account or investment app. Everyday people feel the ups and downs, sometimes without even realizing how much tech shapes their financial future. Fortunes can be made or lost overnight, but it's not random chaos. There's a method to the madness, even if it's hard to see at first glance. There are real reasons behind these swings. Earnings, innovation, competition, and even global events can all play a part. If you understand them, you can stop being a passenger and start navigating the market's waves. Knowledge is your seatbelt on this roller coaster. It's about turning anxiety into advantage and learning how to ride the ups and downs with confidence instead of fear. So, what drives these dramatic moves? What's really happening behind the scenes when prices jump or dive? Let's break down the story behind the numbers and see how the dreams, fears, and expectations of millions shape the market every day. Because in tech, understanding the ride is half the battle. The more you know, the better you can prepare for the next twist or turn. And it all starts with the price of a dream, one that you can follow right from your couch. Tech stocks are famously volatile because their prices are built on dreams, expectations about a future that may never arrive. Investors aren't just buying into what a company is today, but what it could become tomorrow. The value of these companies is often tied to bold visions, ambitious promises, and the hope that innovation will change the world. This makes tech stocks uniquely sensitive to shifts in sentiment and speculation. When you buy Tesla, you're not just buying today's cars, but a vision of electric dominance, solar power, and robotics. You're investing in a company that's betting on a future where technology transforms how we live, work, and move. The price reflects not just current sales, but the belief that Tesla could lead entire industries. That dream can change in an instant, making prices swing wildly with every headline. A single news story, rumor, or tweet can send shares soaring or tumbling as investors react to the latest twist in the narrative. Unlike grocery stores, tech companies are valued on what might be, not what is. While a supermarket's worth is grounded in today's sales and profits, tech valuations are built on potential, sometimes years, or even decades away. Investors pay up for the promise of future profits even if the company barely makes money now. They're willing to overlook losses today if they believe in the story of tomorrow's growth and market dominance. Amazon lost money for years before conquering e-commerce. Others faded away. The difference often comes down to whether the dream becomes reality or remains just out of reach. Every news story, breakthrough or setback, can reinforce or shatter the dream. The narrative is always shifting, and with it, the fortunes of those who invest in these companies. The price is a reflection of collective belief in tomorrow's story. It's a measure of hope, hype, and, sometimes, pure speculation. That's why tech stocks can soar or sink on a single rumor. In the world of dreams, fortunes are made and lost in the blink of an eye. Every quarter, tech companies face a reality check, earnings day. It's when dreams meet hard numbers, revenue, profits, new customers. But it's not just about making money, it's about beating sky-high expectations. A tiny miss can send a stock tumbling, even if profits are huge. More important than past results is guidance, the company's forecast for the future. If growth looks like it's slowing, the dream shrinks, and so does the stock price. Earnings season is the Super Bowl of volatility, where fortunes change in hours. For tech investors, these moments are make or break. Tech stocks are essentially bets on future profits, and how much those profits are worth today is deeply influenced by interest rates. Investors look at companies like Apple, Tesla, or Google, and try to estimate what their earnings will be years from now. But the value of those future dollars depends on what you could earn elsewhere, like in a safe government bond. When interest rates are low, the returns from bonds and savings accounts are tiny, so future earnings from tech companies seem much more attractive. That's when tech stocks often soar, as investors are willing to pay a premium for growth that might be years away. But when rates start to rise, the equation changes. Suddenly, safer investments like bonds offer better returns, and the value of profits that won't arrive for years starts to shrink. Investors begin to question whether it's worth waiting for those distant gains. As a result, tech stock valuations can fall sharply, even if nothing about the company's products, leadership, or strategy has changed. It's a shift in perception, driven by the math of discounting future cash flows. So, it's not really about Apple's latest iPhone or Tesla's newest car. It's about the financial calculations that determine what those companies are worth today. Higher interest rates act like gravity, pulling tech stock prices back down to earth. The higher the rates, the stronger the pull, making it harder for tech valuations to stay elevated. That's why every announcement from the Federal Reserve can send shockwaves through the tech sector, moving prices in a matter of minutes as traders react to new expectations. The market quickly reprices the future, leading to sudden waves of volatility and dramatic swings in tech stock prices. For tech investors, interest rates are a hidden but incredibly powerful force, shaping the entire landscape of the market. And because rates can change quickly, they have the power to change the game for tech stocks, sometimes overnight. Innovation drives tech stocks higher, but it also makes them risky. A breakthrough from Nvidia or Tesla can send shares soaring, but today's leader can be tomorrow's loser if out-innovated. Giants like Nokia and BlackBerry fell fast when new ideas disrupted their business. Every tech company faces the threat of sudden obsolescence. Investors are always scanning for the next big thing, or the next big threat. The pace of change is relentless. A new AI model can rewrite the story overnight. This constant churn creates both massive opportunity and risk. In tech, volatility is the price of progress. Stock prices aren't set by math alone, they're driven by people, and people are emotional. Greed and FOMO drive prices up, fear and panic send them crashing down. Social media and news amplify every move, turning stocks into stories and sometimes frenzies. Meme stocks showed how hype can disconnect prices from reality. A stock's price is as much about popularity as profits. Volatility is human nature playing out in real time. Smart investors don't ignore the swings, they expect them. They know the market will overreact both ways. Volatility isn't a flaw, it's the cost of long-term growth. Understanding this gives you an edge in the tech roller coaster.